Hey everyone, welcome back to the IT Investor Podcast, where we help tech professionals turn their 9 to 5 grind into lasting wealth through real estate investing. I'm your host, Pramod Gudishetty.
And I'm Wally Taylor. Whether you're deploying code or debugging a server at midnight, we're here to help you deploy capital into cash flowing assets so you can debug your life and create freedom.
Today's guest, he is a living proof that you can go from corporate uncertainty to complete control over your time and income. Today, we are talking with Douglas Escobar, CEO of ESC Freedom Investing. Douglas left a high-pressure corporate job in the insurance industry where restructures and layoffs were a constant, built a portfolio of 2,000 multifamily units, and now helps others achieve financial independence through real estate.
And by the way, he's not just another LinkedIn success story. Pramod and I met him at RaceFest earlier this year, and he's the real deal. Sharp, approachable, and genuinely passionate about helping people. Plus, he lives in sunny Fort Lauderdale, which means I'm already jealous. Douglas, welcome to the show. Could you give our audience a quick intro into who is Douglas and what his background is, where he's from?
Sure. Thanks for having me here, Pramod and Wally. So I'm Douglas Escobar. I'm originally from El Salvador, being in the States over 40 years. I came right to university like a lot of the young kids coming to the States and live the American dream, right? I've been in real estate for on and off like 28 years, studying the single family home. And obviously have I was employed by corporate America on and off as well. My last job was a global executive insurance role for almost 17 years, 16 and a half to be exact. So that's who I am. I have a passion for real estate. And I studied in multifamily back in 2015.
That's a very impressive background, Douglas. So you had a very high-paying job, and most people would really hang on to that like it's a golden ticket. What made you say no, and this isn't enough?
Yeah. So it was not, it's never an easy decision to leave a high paying job. That's for sure. Back in 2013, 14, uh, the company that I was working for till last year started going through a series of restructures and layoffs, right? And up until today, it still continues to do so. So 16 and a half years later, every year there's some sort of a transformation, operating model, general expenses reductions, and all the stuff, efficiencies. I saw a lot of friends and colleagues to be laid off without notice, just getting a memo in, uh, in a one-page summary of potential severance package. And I saw the devastation that it basically placed on them. That really made me mad and angry. There was not much I could do about that for them. Certainly, I could do something for myself as long as I had the time to do so. I was fortunate enough that I left on my own term. I never was impacted by any of those restructurings, but I see very closely. I saw friends that were close to me, to my heart, that really went through those bad times. So that really made me look into how I really break away from that dependency on my W-2. And that will let me to really dig into multifamily, get myself educated on it, and start investing in multifamily.
Yeah, you took a pretty huge leap there. I mean, you went from the corporate W-2 job to, I think, 2,000 doors. That was the number that Pramod mentioned. So for our tech audience, there's something called Hello World, right? Where you write your first line of code, and that first line of code is Hello World, and then some bit of programming language. You pretty much went from writing Hello World to this huge program. Can you tell us how you learned how to get into that real estate game? What was your
So
program?
when you're talking about 2,000 units, not just for the audience clarity, is fractional equity ownership in 2,000 doors. Nonetheless, it's still $2,000. Is a bunch of deals in order to get to that number of doors. Okay, so the first things you do is start educating yourself on what you're investing, right? To understand the asset class. I came from the single family home. I had a portfolio of houses back in 2000 through 2007. I sold them all. So I didn't want to go back to that because it was a lot of work, landlording, picking up rents, etc. Although I didn't mind coming out with $4, $5, $6, $7,000 cash every round that I took, okay, because I was picking up rents every 2 or 3 days at the end of the month. Okay, but it was a lot of driving and a lot of phone calls at night and what have you. I mean, I had about 15 homes at one point, and I really started to become a job. So I knew that there had to be a better way to have maybe multiple units under one roof. And I knew I had heard of multifamily as a preferred asset class for that from other people that I knew in the investor community from being in the single family home, which have take also the jump and leap into that asset class. So I started doing that, but it took time, and it just really that just didn't happen overnight. It took a disciplined approach. I needed to understand what my magical number was in order the minimum number uh, that I needed to have in order to be able to build a plan and do some reverse engineering as to what was going to take for me to get to that level of income so I could take that step. But it took time. So it took 10 years. I mean, this and I became work optional probably in 2023. And I pulled the trigger in 2024 because simply I had the opportunity to do so. Uh, and I just did it, and I haven't looked back. It's been over a year now.
Yeah, that's very impressive, Douglas. So, just to clarify a little bit, so you started with single family units and then came into the multifamily sector?
Yeah, I had a pause between '07 and 2013, really, before I started going back into real estate. I was working for corporate at that time, so I was well paid, and I didn't see the need to looking at, which was the mistake. Number one, I always should have been remaining in real estate. But after the great financial crisis in 2008, I really paused on buying. I made a mistake. I should have continued to buy because that was the time to buy. But I sold them at almost six, so I sold them at the top of the market, and I make a lot of money on those single family homes. And I did it because someone, a mentor, told me that I should be looking to selling cash out now because of what's coming. So I paused and for about 6 years before I went back into real estate, but this time to multifamily.
Got it. So, let me dig a little bit more deeper, Douglas. So, you were managing all these units on your own and you were buying every year two or three or something like that?
When are you referring to the single family homes or to the multifamily units?
No, just how like you were scaling. I just wanted to,
Yeah. So what
step
I
back
did,
and see.
so for the single family home, I just started buying one or two houses a year for the first between 1999 and 2003, 2004. That's how I got to about 12, 15 homes at one point. I think I sold some. In 2006, 7, I sold them all. Then I paused, didn't invest, didn't have any real estate. Actually, no, let me step back. I did have two houses left. And I sold them in 2019. But in the 2015, I started investing in multifamily. And at that time, I was doing one deal at a time per year because,
Got
it
it.
was a hefty investment for someone that's not the same thing to buy a single family home that send a wire transfer of 50 grand or 100 grand to someone that you would consider to be a stranger in the internet, right? So I did a lot of research. I needed to have a proof of concept that this would work before I really will scale that up.
Got it. Got it. So actually from 2015 onwards, you moved into the multifamily, you educated yourself. And as for education, you had a mentor and who
Yeah,
was helping.
today I still have a mentor for acquisitions. Like, I thought about going into the active role, sort of what you do, promoting Wally, that, wanted to have my 50 units. But the more I got into the passive side of it while I have my W, and the more I like to get those quarterly distributions without lifting a hammer or without really having a property management to supervise, without having a full team. When I had connected with experts on the field on the matter of multifamily. So I like that. And the first time I got my first distribution check, I remember kind of I felt a little bit liberated. Right? For the first time, I could see money working for myself. It wasn't big, it wasn't sexy. I think I told somebody, "Hey, I got my first distribution. I think it was about $1,000 or whatever, and it was 300. And if by month it would be at $333, right?" So uh, I think the guy laughed at me. And I say, "You invested 50 grand to get $1,000 every quarter." I said, "Well, that's just the dividend. You have the equity ownership, and there's going to be an upside if everything goes as planned. I probably will double the money in 3 to 5 years. But the fact of the matter is I repeated myself, did another investment, continued to produce the second investment, another distribution check. Now it wasn't $1,000 anymore; it was $2,000. Okay, a quarter, excuse me. Then I started, the next deal, I doubled up on the deal. So it wasn't longer just 1,000 every quarter. It was maybe 2,000 a quarter, plus was already coming in, and you start rolling in. Now, so that took time, obviously. That's why when I said 10 years, it literally was 10 years, okay? And along the way, although I would consider myself to be successful in doing this business, I was also hit with a few failures, okay? So that just made me a much stronger investor because I learned from those experiences and what not to do, or not get too overconfident and not get lazy, because you can easily get lazy because you think now the process until reality hits, right? Something will not go as planned. That operator is not as experienced on the down cycles or downturns, or when the issues get tough. The importance of how the organizational structure of the operator is extremely important. So you learn through some of those things. So it just made maybe better. It was a disappointment, but I took that. I'm always a positive guy. So I said, this is just a failure is just success upside down, and you just got to move forward, make it stronger. So, but I always made an investment that will not break my house. In other words, I knew I could absorb a loss if I had to, not that I was planning on, or the quarterly distribution could be suspended and would not impact me in whatever. So I always had that guardrail of downside protection in the event if something were to go south.
Got it. I love that. What you have done. And over these 10 years, you have really believed in this investing model. And in a way, as days were going by, you learned from your mistakes and you made yourself much more better at investing and what to look and how to vet the deal or whatnot. So before we go deeper into that model, I want to talk about one role you always emphasize, Douglas, the asset manager. Why do you call them unsung heroes?
Well, the risk is not in the deal. The risk is in the operator. So I learned that the asset management team is the vertical of the operator's organization that can actually break or make the deal if it's not being executed. If the business plan is not executed to the letter. The deals that I faced challenges had a flaw in the asset management process and the asset management team. So today, that is a variable that I do not compromise from my investment. To me, the asset management team has to be vertically integrated. And what I mean by that is has to be very close proximity to the property. Okay, not that you are 5 hours away from it. And again, I'm not saying that it doesn't work. I'm saying that I'm not willing to gamble that. So I seen people that make it work, successful operators that can have far away asset management, and that's fine. Today, I do not gamble on my own money anymore. And for anyone that want to invest with me in the future, for example, I'm not taking to take that gamble as well. So that's the asset management to me is the Navy SEALs of the organization. Okay, it's really the one that executes the business plan, is the one that holds accountable all parties of the business plan, from property management, construction team, maintenance. All the leases are not, the vacancy's gone way too high, all that stuff. I mean, that person is that's the glue of the business plan. That what keeps it together. If that's weak, and you might write it and you might get lucky and you might never know. But the moment that it goes south for whatever reason, it might not be under the control of the operator, but that asset management team will know how to play around and, or at least mitigate the process. Okay. But when it's weak, anything that it goes south will really over extrapolate the downside effect of that.
Yeah, absolutely. I mean, from what I'm hearing, the asset manager is like the most important part of that general partnership team. And if that person's weak or that group is weak, that's just that's a bad deal. Not to go back, but 10 years, sounds like you've been in the multifamily space for 10 years. That's a long time in the market. That's pretty much you've seen all cycles of the real estate market at that point. Uh, Aside from, picking a good asset manager, it sounds like if you had some deals, maybe that was weak. That was a weak piece that might have broken something up for you or made it a learning experience. Were there any other big lessons that you've learned in the last 10 years journey?
I can go back in hindsight and say a lot of the deals that I was successful on, I think I got lucky, right? I mean, that's the reality. I can say most of them is because I've been with the operators they're very good operators, right? The operator are good. The operator is good. You got a good asset management team. You got a vertically integrated organization. And somebody asked me last week, what's a vertical integration? So just for the clarity is basically everything has to be in-house. Okay. Every swim lane of the process needs to be in-house. Property management is the one that you can outsource, but the asset management team or the asset manager that oversees the property management could be either the operator, depends. But if they have a scale, they're going to have an asset management manager. Okay. That handles, anyone that has more than 150 units, 200 units in one deal has to have an asset manager. The operator cannot just be running it by itself. Because the operator will be looking for and sourcing all the deals, right? That's his job or her job is to source deals and bring into the table so he can keep his machinery turning all the time. He can, afford to keep people in payroll and all that stuff. But so that's the vertical integration. So you got your capital raising team, right? Could be in house, or you can have today a fund of fund manager that you have great relationship. He can help you bring cash to the deal. You need to have that asset manager, a very client who also oversees the property management and the construction team. And even within the construction team, if you have a scale, you need to have an in-house GC. Okay. That handles the strategic aspect of the construction and the timeliness of it. And then you can outsource the labor to do the work, the people that painter, the people that lay out the car, the people that bring the kitchens and the LPV floors and whatever. So as you go into that, that's the vertical integration that I'm referring to. And I've had a lot of discussion with probably much savvier investors, and some people think that that's a little bit too extreme. I said, well, maybe it is, but that is really the risk management aspect of me. Having spent 16 and a half years in the insurance industry, we're taught to assess risk and price it and put guardrails around the policy and the coverage and the risk mitigation aspect of it. Okay. So when I look at the investing aspect of it, that's how I look at it. Right. I look at it like a policy. What are they offering? What is covering? Okay. Who is behind that policy? In insurance, that's what we do. We evaluate who the business owner is. Not because you're asking for a policy, they're going to give it to you. You want to know who's running the business, the experience, who's the bio that they have from this executives in that business and what have you. So it is similar, the same process, right? Before we even look at a policy, which is the product they're looking for, the terms for the policy for the product they need to cover, then we guardrail it. Here we have assessed what they're trying to cover, which is the risk, and then we put the guardrails in it, and then we move forward and let it go. It's the same thing for a passive investor, right? They need to understand who is behind the deal, right? Who the operator is, what is, the experience they have had, how many full cycles they had, how they responded to adversity. It's not about that they had to be successful in every one of them. If somebody has been successful in every single deal, they're lucky they're lying, right? So one of the two. And there's no way to grow. You had to have challenges in order to get better at any role that you're in, either you're an investor or whether as a GP or part of the group. So that's how I see that as with that risk mentality, right? The risk mitigation mentality, that insurance DNA. So today, asset management, I simply do not compromise. I get deals every single day, and I probably get 1 out of 20 that I might look into, just because most of them do not meet the my box. Okay, I might be missing opportunity, maybe, but I'm for sure not gambling on something that maybe could go, maybe could go right, maybe could go wrong. No, I just and nothing is guaranteed, right? Even with all that guardrail and mitigation process, it's still things can go wrong. But at least I know we've done everything we can from my side as an investor to cover any downside. Usually my experience with the operators, they're good, man, they know how to navigate. Okay, they do. The ones that don't, you can quickly see what the flaw is. Okay.
Yeah. Yeah.
Got it. So basically, Douglas, you basically look at a deal through insurance risk manager's lens. Well, what I definitely learned is we have to do the due diligence. We need to look at who is behind the deal, who is the asset manager. That's all good. So apart from that, do we have to do, or did you have to do anything else, or look at the numbers, where the
Well,
property is,
absolutely.
the location is?
Absolutely. Once I vetted the operator and its organizational structure, then I'll spend the time to review the numbers. If it is a brand new operator, which I don't get too many new operators at all, I basically got my select people now, so it makes the process easier now because now I see how they underwrite, I see what their assumptions there. So, but assuming the right process is yes, I will look at the location, right? So what I do a Google map view of the location. I want to see if, especially in a market that I never invested, I want to see whether it's rural, whether it is metropolitan area. I want to see what it looks like, if there is population around it or not. Okay, if it matches to what they're saying in that pitch deck. Okay, then I certainly look at and this is, we have already vetted the operator cycles. I probably talked to the investors. I already feel comfortable moving up to looking at the numbers. Then I look at the performance, the projections, and whether they're, the type of debt structure they're looking at. The entry cap rate and the exit cap rate is very important to understand. But then the most important number in underwriting a deal is the rent projection. Okay. Especially, I'm talking about a value add strategy multifamily deal, because that's really what's going to make the stabilization point to reach to the market rates they're trying to achieve and what that plan entails. So if that's realistic, on the growth rate, I'll check reports like CoStar reports. I'll go to apartment.com for rents of that in that area for similar properties. I'll start vetting their underwriting box against my own due diligence. Okay. And I would challenge that when somebody says, your rent rate increase, after stabilization is 2, 3, 5, 6%. 2% I can get it, 3% maybe today, and that depends on the area. Now you can jump from a value add from where it is that is under market rents to a stabilization of about 20%. That's reasonable because you are bringing in modernizing and adding appreciation to the property and bringing the units to market rent. But once it's stabilized, they continue with the projections. It has to be extremely conservative because otherwise we know what can happen, right? I mean, I look at the supply chain of permits in construction in the area versus where is that going to be in 5 years? So I try to look how far I can get that information, right? So, and based on that, what I get, I can go along with what they're saying. Why challenge? If they cannot answer what I'm challenging in a thoughtful and probably expeditious manner, I move on because they don't know.
I think something else to consider too with those rent increases is, do renters in that area have other options? You mentioned checking the market rents. What's the occupancy rate in the market? If it's not that high, maybe the demand isn't high, and you really can't look for that 2% increase. So, in that first year. I know when I first started underwriting myself, you're taught, hey, 1 to 3 to 5% that first year. That's just not reasonable. Usually that first year, you're not raising rents at all. It's just to keep your current tenants happy and make sure you're attracting some new people just to get the occupancy up. So yeah, that's a good point you made there about not bumping that rent too fast in that first year while you stabilize.
And let me tell you something, Wally. That's exactly the thought process. But when you're working on a value add strategy, you can have those rents probably be 10, 15% down. Because if you have a legacy owner who's kept that building free and clear, and really they want to keep that a 98%, 100% occupancy. When it's 100% occupancy, you know rents are below market. Okay. I mean, just from the get go. And they're classic states, you know that they have not been renovated. So then I would expect a very good operator to say, if it is a 60 unit building, which is that's between 50 and 100, 150, that's my sweet spot. And there is a reason for that. Okay. It's timeline. Okay. When somebody offered me 370 units, I kind of cringe a little bit because that takes 4 years. The higher the probability for some external macroeconomics to develop that it's out of your control, that there's no way you could see right away on the underwriting process, unless you have a crystal ball. So a value add strategy can jump the rents very quickly. But once you hit that market rent, that 1%, 2% becomes extremely hard. And that's why it's important to see what's coming up. What's the new construction coming up in that area? If there is none, then you're in a sweet spot at least for the next 5 years. But if there is new supplies coming in, I will even question, what the purpose of the value add is. We got new construction coming in exactly. Then you start going, you're challenging every assumption why this deal will be a good deal now. And the cost basis you're buying it for is extremely important, right? So if I'm buying a door for 50, 60 grand, and I know that the door today might be 80 as is, I'm getting a great deal no matter how it happens. So I have the opportunity to raise rents. And again, a great operator will execute surgically into that process.
Sure. Yeah, another key takeaway before we jump into the fund of funds and how that works is you mentioned the number of units coming online, and can the market actually absorb that? That's something that I wouldn't call it a painful lesson, but something I've learned on my last two investments in the Dallas area and the Charlotte area. We made some acquisitions, it's all good, but there's a lot of new inventory coming online, so that ability to raise rents and get the occupancy up has been stifled because of that. People have a lot more options, so really good.
Exactly.
Really good.
And one of the reasons I remain within my mentoring within acquisition and sourcing deals, even though I'm not an active guy, it's just because I get the latest of the latest intel in the market, at least that I like. I'm very bullish in the Midwest, especially in Cleveland area. Okay.
Well, pro tip
Yeah.
there for those paying close attention. All right.
Douglas, so I have a two-part question. Have you ever walked away from a deal that looked good on paper but didn't pass your gut check? And the other question is, I know you were mentioning that you always try to invest in value adds and you have a sweet spot of number of units, whether it is 100 or 150 units. Is that what you look when you...
Yeah. So I walk away from deals every day and they look good on paper. And most of it is because the asset management team, they don't have somebody boots on the ground that they manage remotely the property management team. If there's no one sitting close, and I'm talking about no more than 2 hours away, I can even give you no more than that. I can tell you that's not going to work when something goes south. Okay. Unless you go back, because that person, something goes south. And this is what I want to make sure people get in their head. When the deal goes south, it's a spiral down of things, a domino effect. You need to live in that property to make sure that the people are doing everything possible, from the execution of the leases, from marketing, from maintenance. I mean, understand that whatever they can do to sustain that, to turn that around, is being done. Being far away just doesn't work. You won't have the bandwidth nor the time to go back and forth unless you go and implant yourself in it. Okay. I seen it again. People might disagree with that, but that's something that in my underwriting process, I do not gamble. Going back to the size units, listen, I like the 50 and 150 because most of those units can be turned around in 3 years or less. Okay. Okay. So I'm not afraid of the 370 because I had it. The 370 doesn't mean that all of them are going to be renovated. That means maybe 50% might be renovated. They might think about that. But always when you got that kind of units, you're thinking about 5-year plans. That's usually the typical, even in the smaller units. But your business plan of renovations has been done within the first 24 months in those smaller deals. So when you've done that, you have already eliminated a lot of potential external risk. You can get impacted by other risk, but the fact of construction delays in that, in the smaller units, in my opinion, at least my experience, it's been more manageable. Again, it might be because the operators that I'm with, they're managed extremely well, the in-house aspect of it. They buy in bulk, they store. It's a rinse and repeat process. It's the same colors, the same materials, right? So they buy in bulks, they bring the cost down, and it's a rinse and repeat. They're not trying to innovate every time they get into a deal. The bigger it gets, I think you're just simply extending yourself to external risk of macroeconomics that you just may not be under your control. That's just my insurance risk
Sure.
problem.
Yeah. The longer you're in something, the higher the chances that something completely crazy could happen, right? You look at like coronavirus or the housing crisis 2008, right? Like
And that's exactly now. That's the value and the value add. People would argue, but you're at the long term for the plan. Absolutely. I said, but if you do not execute that business plan, you get hit with any macro external risk. Nothing else happens. You execute your business plans. You got some external risk that happen you cannot control. At least you have it done. You can hold it. You might not provide distributions, and you're gonna write it. And the debt structure is extremely important. Another thing, Pramod, I do not invest in floating debt. Don't. And somebody asked me, well, why not? I said, well, you've got construction, makes sense. I just don't. I just don't like it. I mean, that's one of, we see what happened with the interest rate in the last 3 years, 2 years, that incredible fast pace of increasing rates. It was something unseen from, we haven't seen that in 50, I don't know how many decades we hadn't seen that, at least not in my time. But people still gamble that. They didn't buy insurance cap rates. They didn't do any of that. When they got hit, man, it didn't matter how, it just didn't matter what, And on top of that, you didn't have the asset management team in place as it should have been. It just simply was a bad deal. So those are two things that I really don't compromise from my, I either like agency, bank, debt. Don't get me bridge loans. I would look at it and I want to see what guardrails that person has for that bridge loan. I will consider, but the minute you tell me bridge loan, it's already that deal's gone deeper and deeper into my stack. Because there are other deals that I prefer my investment. If I didn't have any other deals, maybe I would consider more. But still, it just that's why I don't go into development.
Got it.
But
great tips. Pramod, you want to pivot over to the fund to fund models?
Yes,
How
sure.
that works?
Yeah. So myself and Douglas, for the benefit of the viewers, we have joined Race Masters, and that's where we actually met. So having said that, Douglas, can you break this down for our audience? How does the fund of fund model work, say for busy IT professionals or anybody?
yeah, so the fund of fund model is really what you get is you investing in an entity that in turn will invest in the entity that owns the asset. So you are buying also securities into an entity. That entity is managed by someone. It's called a GP or the fund manager for that entity. But together, as an investor, it basically you have an LP status on steroids. That's how I call it. Because instead of investing $50,000, you come as a group and invest $1 million, maybe 500,000, and you more likely will get better economic terms from the deal because you probably will get to a different class shares that will have better economic terms. So the investor can to either equally either match what they're getting, how they gone directly, or better terms. And the other thing, most of these deals you usually have a high entry barrier of money or capital deployed and needed. You in the fund of fund, you can set up your own limits, right? You can bring anything from $5,000 to 100 grand or more per individual. It's all up to you. So you might allow somebody that might not have that 50 grand, that 100 grand to go directly. And you bring it to you and you allow them, they can piggyback on that process to get the same returns they could have gotten had they gone directly at a higher entry level.
Yeah, that fund of funds model, it's just a great way for the new investor to kind of dip their toe in the water without putting a big chunk of money down to kind of see if this is like the asset class that they really want to invest with. So really, you as the fund of fund manager, you kind of provide that infrastructure. You give the investors that opportunity.
That's right.
I know myself, my first investment I did through a fund of fund as well. And it was nice because I'm still creating my wealth. I'm not an accredited investor yet. So I went, I networked, I met people, I created that substantive relationship. And then I was allowed to view deals that maybe an average person off the streets couldn't get their hands on because I was educated in the multifamily syndication process. Yeah, it's been a great experience for me. And I've done 3 now, and
That's awesome.
working towards more.
Keeps on adding. And I think a couple of things that people need to understand about the fund of fund is also allows them to be in compliance with the with the SEC regulations, right? Number one. Number two, they are choosing to invest. You simply, as a fund of fund manager, you're presenting the opportunity. You're not advising it. That's very important because fund of fund manager could be a licensed advisor, but it's not. Most fund of funds are not. Most funds manager are not a licensed advisor, but are allowed to put that, manage the fund. There's an opportunity. You choose to go in it or not. That's up to the investor. But they basically guide it, right? They guide it to you're leveraging the experience in a fund of fund manager. Let me just step back. Should be vetted as equally as hard as the operator. So if someone's going to use a fund of fund, they gotta vet the fund manager. The fund manager basically is, what you're betting is, what's your experience as an LP? How many deals have you had as an LP? Why should I go with you and know somebody else? That's like great questions. You had to answer the same thing. Well, in my case, I just offered these 10 plus years of experience, over 2,000 doors of fractional equity ownership, successes and failures, a risk management approach from an insurance lens. All that coupled together brings a lot of value to the table for others to look into. So that's really, I'm not that I'm any better than anybody else in the sense. I think I have some unique characteristics that can serve other people better. That's just all there's to it. I wrote a book, Pramod, as you know, Work Optional, right? It's called Work Optional, and the subtitle is Risk Managed Path to Passive Income for Insurance Professionals. But it can be for any profession, right? I just speak the language of my insurance community. But that's exactly, and it created a blueprint of 7 steps. How can they start, right? And really, in that book is. As a matter of fact, if you see some of the content to go to this week, it's all about the blueprint. Like it's different steps that I take, right? So, that's and I wrote it because I wrote it from the lens of an insurance optic and the experience of 10 years, and the wisdom and input from great operators that I partner with. So that book is full of great information, not only my experience, but what I learned from other people. Okay. I have a master class. It's a 5-day email series where I teach LPs how to vet a deal. And it's very packed 5 days information, valuable information of my team's experience, and the input from a lot of operators, a very few selected powerful operators, and that I really admire.
Well, I hope we can find out more about this masterclass. I'm sure we have some listeners who want to hear about that. I'm curious myself. I may have to shoot you a message
Actually,
offline.
You can dig me in LinkedIn. You can DM me. I can send you the link for the masterclass because it's a special link for the masterclass. It did get a lot of traction when I promoted it. The promoter it's free, it's just I like to educate people, right? I mean, I like to transfer what I know, and obviously my job is to continue to improve those master classes as I learn more. Because what's beautiful about this is you continue to learn every single day. I experience myself in multifamily, but because I'm in a different season of life today myself, I started to invest in debt funds more and more. Okay. For a cash flow perspective. And I done my due diligence. I done everything. I invested in, and I'm going to start helping promote those funds because I think I wish I would have known this 10 years earlier, right? I probably would have a much stronger diversified portfolio. Not that I'm have anything to regret about the multifamily, but I'm just saying it's part of the diversification, right? So that's you learn more and more different structures of. There is more asset classes that are still asset based. Sorry, I lost you for a second. There are asset based lending and or that are backed by real estate as well. So you continue to learn this. Eventually, I'll be probably extending that master class to talk more about as I get more in depth in this.
Yeah. So, Douglas, the goal in those master classes or in your book, which you have written, Work Optional, is it like you are conveying that passive income lets you reclaim the time and avoid like the
Yeah.
toxic work environments and all that?
My message is this: work optional. You work because you want to, not because you have to. I'm not inviting anybody to quit their W-2. I did it because for me it was the time to do it. Okay. What I'm saying is you'll be immune to any layoff, restructuring, promoter, you have your
Yeah.
profit as well. It's nice to get those checks, monthly checks or quarterly checks that covers part of your expenses of all expenses now. And you really you have a peace of mind that basically makes you agnostic to pain of potential restructuring, right? And that's the whole purpose of the work optional. Is basically you work because you choose to, not because you have to.
Yes, got it. So, Douglas, I think we are coming to the end of this show. So, how can our viewers reach you?
Yeah. So two ways. Easy way. The easier way to go is to LinkedIn and look for my name, Douglas Escobar. They can follow me there. They can DM me there for any special information they want. They want a free copy of my book. I have an ebook that I created that I can give them the link and they can download it for free. They don't have to go to Amazon. By the way, it became bestseller at Amazon. So I have a
Congrats.
bestseller in it. So then, or they can DM me for the master class, or they can go to my website, escfreedominvestments.com, and they can book a call. They can download our white paper. I have a bunch of resources. But I think the easiest way for them is to reach me in LinkedIn and DM me directly and ask for a connection request and whatever. I'll be happy. I'm here not to sell anything. I'm here just to provide as much valuable information so they can help them make decisions as they move into their journey of investing.
Douglas, it was great talking to you today. And let me wrap up what the key takeaways today are. Job security is fragile. Always have a plan B. Vet the people who is behind the deal, not the pro forma. Asset managers are mission critical. And as you said, Douglas, risk is in the operator. Risk is not in the deal, but the operator. I like that. Fund of fund is a perfect way for busy professionals to make generational wealth. Build wealth so work is optional, not mandatory.
That's right.
Yeah. I also wanted to just point out something that Douglas just said there at the last statement, is that you're not trying to sell anything with this masterclass. Like, just the fact that you're sharing information, that is massive, because there are a lot of gurus out there that say that they're, expert multifamily syndicators, and they charge thousands and thousands of dollars, to learn how to do some of this stuff. And to meet people that just want to share and help people learn and grow is very refreshing, man. So thank you so much for that. It's been a pleasure having you on today.
Thanks for having me. And I think the last thing I want to say that if you ever want to get to from point A to point B, and the faster way to do so is to get a mentor anywhere, right? So this is just if someone who's done it, who's walked the path, just get with that person. Again, make sure you do your due diligence. That's the true deal, right? But that's the faster way. Otherwise, I mean, I can provide information, like I said, and people can just gain little by little, and then they have a better view of what that is and how they can go about it, right? So it's just serving others, man. That's my whole purpose, to serve others. That's they can just have a better option later on.
Love it. That's great.
As I said, that's great again, Douglas. So next time when I got a question, I know whom to call and seek the advice.
Well, thanks, man. Thanks, likewise. But thanks for having me. I really had a great time, and I hope your audience finds this at least valuable information, or one key takeaway they can get it that makes them better. That's been well served.
Yeah. So if Douglas' story resonated with you, connect with him on LinkedIn or check out ESC Freedom Investing.
Yep.
And until next time, stay sharp, stay focused, and keep building wealth that works for you.